Welcome to the Baker Tilly US podcast, an online community developed to connect you to our partners and leaders across the globe. Subscribe today to continue discovering new and unique ways that Baker Tilly can enhance or protect your value as we discuss timely, relevant, and impactful topics. Our current series is specific to real estate professionals. We recognize that the coronavirus is affecting real estate companies and organizations across the world in unique ways. In this podcast, we will speak with Baker Tilly practice group leaders about practical real estate guidance to help you through the next several weeks and to prepare your business and employees to come back strong in the future. Let's get started.
Hello, and welcome to this week's edition of Buzz House, our Baker Tilly weekly podcast where you can find all the buzz affecting multifamily housing. I'm Don Bernard, the partner in charge of Baker Tilly's multifamily housing practice, and I'll be talking with my partner in crime, Garrick Gibson, who also specializes in consulting on multifamily transactions around the country. Today, we spend most of our time on the topic of looking at possibly refinancing your property, be it affordable or market rate, in this interest rate environment, which you all know is again at an all-time low. This will include a discussion of refinancing a project within the 15-year tax credit compliance period, which has not been commonplace. We just have a few items we want to touch on briefly before we get into the refinancing piece. One business idea that Garrick and I and other partners have been talking about recently is the idea of looking for multifamily acquisitions, where we might see cap rates rise a little bit, interest rates low, and just let you know that our affiliate Baker Tilly Capital is available to help raise equity for these multifamily acquisitions. One other thing we want to talk about is our anecdotal information on discussing tax credit pricing in the equity markets the last week or so. We have a number of clients with both 9% awards, 4% deals going through diligence. They really want to kind of find out where the equity pricing is, and as a result of the ongoing pandemic. Over the last week or so, I've had a chance to talk to a half dozen investors, and for the most part, the message was consistent. Groups are open for business, but definitely a lot of uncertainty in the market. The best advice may be holding off for 2 to 3 months, staying in touch with your equity investors and so forth. And really kind of other than just this consistency of the uncertainty, that maybe pricing would be 5 to 10% lower than bids that were going out 4 months or so ago. Garrick, are you seeing consistent, or what are you seeing around the equity market today?
Yeah, I had an opportunity to talk with several folks as well, and it's the same message. Basically everything you said is exactly what I heard from them.
Mm-hmm. And so be watching this, be watching what's going on with timing. Obviously, lower pricing create financing gaps, create timing issues with your deal as you move forward. We talked on our last podcast in the Buzz House around timing, 10% tests and so forth, so being alert for that. I think it's also important as you think through your deals and issues to continue to talk to your congressional representatives, as a lot of talk, again, as on our podcast and others in the industry, talked about fixing the 4% rate at 4% and also increasing the allocation of 9% credits, again, which the industry is pushing hard for. One other quick note before getting into refinancing. Garrick, we were talking just earlier this week, in fact, with a client looking to resyndicate some historic tax credit deals. And we know there's also some things the historic tax credit industry is pushing for out in Washington to help spur economic recovery. What are a couple of those points in the historic industry?
So with historic project construction also being delayed during this pandemic, and the importance of renovating vacant or underutilized properties such as schools, warehouses, or other commercial buildings and bringing additional investment in communities, the historic industry is also proposing a number of things. Some of what I'm hearing is increasing the credit for projects to 30%. It's currently 20%. So increasing to 30% for tax years 2020 through 24. And then from there on, providing sort of a phase down of the higher percentages for all properties. So 26% in 2025, 23% in 2026 before returning back to 20% in 2027. So this increase would be for qualified rehabilitation expenditures paid or incurred after January 1st, 2020. So with that increase in changing the 20 to 30, not only does that actually account for lower pricing that we're currently experiencing, but I think it'll make the smaller but equally important projects deliver a larger amount of tax credits, making these smaller deals easier to attract equity. They're also proposing extending the substantial rehab project by, term by a year instead of 2, making it out to 3. And then one interesting thing I heard, which actually is related to twin deals where you have LIHTC, low-income housing tax credit, and historic tandem on a project. As you know, the historic credit, unless you're doing a lease pass-through structure, has a basis reduction. So some of the folks that it would be great to propose, because we have obviously a need in affordable housing, if you're going to have a LIHTC project and you have historic tax credits on it, that you get a waiver of the basis reduction. So, for instance, I'll give you an example of a project. We had a $2 million historic tax credit computation. That would be a reduction of $2 million from the actual rehab basis, which was in a QCT. So that $2 million would have been boosted by 30%, and then credits would have been computed off on it. It was a tax credit bond deal. So they're losing out on that tax credit equity because of the basis reduction. And someone could say, okay, well, at least pass-through structure, there is no basis reduction, and you could pass it through where you have a structure where you have a tenant and a master landlord. Unfortunately, though, not all deals are going to be able to work that way because, as you know, in the historic, the investor is going to require some economics, and sometimes it just doesn't work right. And the efficiencies aren't there. So that change would be great. It would be beneficial, for the low-income housing tax credit industry. There's a lot of properties out there, as you know, that we work on that are historic, and they're converting these to apartments that are affordable.
Garrick and I will keep you up to date on what we're seeing on the historic, obviously, as well as LIHTC and other multifamily updates. Now we want to switch over to what Garrick and I think is extremely important, and there's many opportunities. Obviously, in this time, that cash on hand is important. Ongoing cash flow, extremely important, is, again, really looking at refinancing your multifamily property, again, be it market rate, be it affordable, with any type of subsidy and so forth. Garrick and I have been spending, over the last couple of weeks, time with developers, owners, times with lenders, starting to look at clients' financials, portfolios, and so forth. Just a lot of opportunities right now. And really the interesting thing, too, the little brief history just within the pandemic is right after the pandemic, people were really afraid about liquidity in the market. Shortly thereafter, the Federal Reserve, of course, intervened with an influx of capital aimed at settling the markets. And now we see, rates on many products, mid-3s, sub-3s, just, again, historically low. Tremendous opportunities to refinance your properties, again, or acquire properties. Many of the loan products will be very similar. And Garrick, what are some of the things, let's start with refinancing. What are some of the things to consider when evaluating, how do I start? What do I need to consider when looking at a refinance opportunity?
Yeah, first of all, you're right. Entities are concerned with cash flow at the moment. Refinance can help products pay off deferred development fees, establish reserves that are needed, and maybe assist with any of these pandemic-related cash issues. But some things to definitely consider, there are some hurdles and drawbacks. Your existing debt may have yield maintenance or prepayment penalties. I know some bank loans have yield maintenance provisions, which may equate to prepayment charges even in excess of $1 million sometimes, so depending on the deal size. So deals where there is no prepayment penalty or maybe just a percentage of unpaid principal balance are going to be better candidates, or maybe your yield maintenance is close to the end of that period and it's not so detrimental when you start running the numbers and doing the math. Some other hurdles, drawbacks on refinancing you want to think about is really size of the loan. Lenders, of course, they all want bigger loans. I think anything above $5 million is great, but given the current situation, even above $3 million is great. But I think lenders would probably consider $1 million or higher, especially if there is a pipeline from one borrower. There are some specific, loan programs out there that have their own sort of drawbacks. Some, you might replace current existing debt, but the debt you replace it with may have things like limited distributions or whatnot, but especially a lot of the agency debt out there that has very low interest rates. They might have other things, but in the end, you got to run the numbers and do the math, right? Because there's plenty of benefits. Take I guess the HUD 223F is a great example because we have a couple of examples that I want to go through that we were using this particular product. This is a product where, the refinancing amount is the greater of 80% of loan to value or 100% of the total cost of refinancing the existing indebtedness and other mortgageable transaction costs. So by being able to refinance with this, you could potentially pay off any of these deferred fees or other sponsor loans that could be considered eligible debt that could be paid off with this refinance. One example that we were running, it was a LIHTC 4% deal, midstream, and the existing rate on the debt is about 5%. So when we did ran it with a 223F refinance example, another HUD product, the refinancing was limited to 80% of loan to value on this project, but the results were great. They were able to pay off the existing debt, which had a 3.5% prepayment penalty. But, I'll get to that later. They were able to pay that off, about $700K in deferred developer fee payoff. It added an additional $65,000 in annual cash flow savings. And the GP was able to cash out $1.3 million, and the LP received their 10% of that, approximately $140,000 out of that project. That was great. And another project we looked at, it was a $6 million loan. It was going from a product with a current rate of about 4.45. I think they were quoted at 2.2 or 2.75. That was the rate on the existing product that they were trying to use for the refinance. The deal is showing now $85,000 more in cash flow per year. So, I wanted to go with our specific examples because what better way to illustrate benefits than just give you, live example where people are actually saving money here.
Right. Those are like incredible dollars. And again, with the cash in your pocket, I think some of these debt cover ratios we've seen, Garrick, are probably 130, 140 or higher. So getting you said a secure position with your asset as well. You talked about tax credit deals, Garrick, and again, I think tax credit deals in general, you'll go through year 15, we're not going to change anything over and things and so forth. But I think, again, with these rates, I think it's incumbent upon us to look at these deals. How do you approach an investor? What are some things that the LIHTC investor will think about, or what could be a challenge, in a LIHTC deal?
Yeah, thanks for asking that question because, in the above example, obviously there was a simplistic example of what the benefits were, but in the end, it was a 4% LIHTC transaction exercise. But keep in mind, in these LIHTC deals, the tax credit equity investors are going to need to approve a refinance. With lower interest rates, they might say, hey, losses are going to go down. It might affect our after-tax IRR. Albeit, though, depending on the cash out proceeds and prepayment penalty deductions they're going to receive, that allocable deduction and distributions to the investor might counteract the effect of those decreased losses. So an example that I mentioned before, there was $390,000 of a prepayment penalty, and that's an immediate deduction. And then by paying off the existing debt, those loan fees that were there for tax purposes would have just been written off at that point, and then the new loan fees would have been put on. But those deductions plus that, I think it was approximately about $140,000 of cash, that should be more of enough to counteract any effect that they might realize from decreased interest deductions. In addition, there's certain things when you got to look at these new loans, and they might come with certain different restrictions that are on there. I know if you put certain loans on now, they might have prepayment penalties that are sort of starting over again. And so a lot of investors we run into, they don't want to necessarily consent to a new refinancing because they don't want any additional prepayments or restrictions at year 10, depending on how close you are, because they might want to try to either get out then or within that 5-year window when they're exiting in year 15. So, but if that's the case, you can always just talk to the lender, and you might be able to work out a structure where maybe these prepayment penalties are going to be lower within that time frame in year 10 or 11, 12, 13, and 14, 15. But in that scenario, it's likely that if the lender is going to move that around, they're probably going to increase the rate a little bit. But again, if we're starting at a 3 or even sub 3, it's likely not going to get up to any levels that are as high as some of the rates I see on current deals right now.
It's a lot of great information. As we wrap up today's Buzz House podcast, we want to let you know we'll definitely monitor and give feedback on May's rental collections. I think for the most part, the industry saw a pretty strong, relatively speaking, April collections. We'll keep our eyes on that and share with you anecdotes, as over now 30 million people have filed for unemployment. Thank you for tuning in today, and feel free to reach out to Garrick or myself with any questions about today's podcast or to brainstorm on your refinance or acquisitions. And please check out bakertilly.com for many other resources around COVID-19.
Also, to our listeners out there of this podcast, if there are any topics you want us to talk about, you can always just send us those topics and suggestions to build@bakertilly.com. That's build, BUILD, @bakertilly.com. Thanks.
Thank you for joining us today. To receive notification when new episodes become available, please subscribe to Baker Tilly US wherever you get your podcast.